Just a few months ago, Fitbit tried to raise money in the private market and couldn't. Why is it so much easier in the public market?
Well, usually it's easier in the private market these days, but for Fitbit, I think it's a consumer brand name, so those deals get a lot of attention in the public markets.
Why? Because my mom says, I've got a Fitbit, I want in on that deal.
It's like when Twitter went public and other, consumer-focused companies. Fitbit's got big market share in the wearables market. It's playing into the trend of health and wellness. It's, I think, going to get a lot of attention in the public markets.
And in the private market, what was the issue? There they are right now getting sued by Jawbone. Jawbone making the claim that Fitbit has no R&D. They're stealing their trade secrets, and the fact that at the same time, and their people, at the same time, Fitbit, through Morgan Stanley, is trying to push an IPO through, kind of makes some of us scratch our heads.
Yeah, I don't know what the issue was in the private market. Could have been the legal situation, but it's getting a lot of attention. I think it's going to have an interesting debut in the public market.
Steve, with as much money available in private markets as there is, Uber is just one example of companies that can raise extraordinary sums at nosebleed valuations. What's the incentive to go public with all, even with the Jobs Act, right? Being public is a pain in the butt.
It is a pain in the butt, and that's why I think you've seen relatively few companies go public. And they're now the famous unicorns, the private companies that are worth over $1 billion that have yet to go public. And that number's just getting larger. People out in the valley who I talk to, the entrepreneurs, say, why do I want to go public? It's just what you said. Why do I need this misery? And you've obviously had some IPOs that have done better or worse.
What's the impact going to be? What's the impact going to be on capital markets? What's the impact going to be in the economy if that trend continues?
I don't think it's bad. I think as you guys just discussed, the fact is that these companies can access unbelievable amounts of capital from private sources. In fact, you could argue the valuations are really pretty inflated. So there's no shortage of capital. There's no issue about companies trying to get started. And
not good for investment banks like JMP, though.
If valuations are inflated, does it surprise you? Earlier today, Eric and I spoke to David Plouffe from Uber, and we asked him, your original investors, when Uber was valued at less than $1 billion, have you seen any of them trade out now that it's at 50? And he said no one.
And that's not true.
It's not really quite true. You do see a certain number of secondary sales in the private market out of these early companies, but that's not bad. Some of these people have been in for a long time. They've made a ton of money, and they want to take some chips off the table.
I was speaking to somebody yesterday who has a personal friend who's a very early-stage Uber investor who said he cashed out at, I think, 25,000% return.
Yeah, but why is he bragging about cashing out when the value is...
Oh, this guy isn't. He was just commenting on it.
Oh, okay.
Yes, no, it's quite possible that it's just going to continue climbing, right?
In some of these private rounds more recently, a lot of the early-stage investors are getting a chance to get liquidity. So it's not only providing liquidity for early-stage VCs that got into the companies, but they keep getting these higher valuations. The other thing that's going on, especially with that last round with Uber, is it's highly structured. So the investors in that round have a ratchet to whatever the IPO price is. So it's creating some issues in the capital stack for the earlier round investors.